Welcome back to the Deep Dive. Our mission today, as always, is to cut through all the noise and give you a really structured understanding of yesterday's global movements. We'll use our sources to distill what matters and maybe more importantly, why. Okay, let's just jump right in. If we zoom out across everything that happened yesterday, from finance all the way to infrastructure, what's the simplest way to summarize the world's direction right now?
Well, if you look past the daily headlines, the biggest trend we're seeing is that global resources and capital are being squeezed. They're being forced into new pathways.
Squeezed.
Yeah, we're sort of moving away from those high-level abstract policy debates, the what ifs, and instead we're getting fundamentally constrained by the actual mechanics of moving and powering things.
So the focus is shifting.
It's shifting dramatically. It's all about the implementation layer now.
That idea, the shift to implementation, that gives us a perfect framework for our first deep dive. Let's start with the headline commodity move. It has a high global weight. Crude oil just broke that key $60 benchmark. What really surprised me in the sources was just how fast the market reacted. Aggressively.
Oh, it's instantaneous. The background here is all driven by these strengthening observations, not facts, but observations of potential movement toward a Russia-Ukraine peace process.
And that immediately sparked speculation.
Instantly, the market speculates that sanctions might ease, which could just flood the world with increased supply.
So what was the actual trigger yesterday? Was it just that anticipation?
It was. The anticipation of that increased supply pushed oil prices below $60 almost immediately. The market just didn't dwell on current geopolitical risks at all.
It just evaporated.
It did. It shrunk what analysts call the geopolitical premium, and instead it priced in a risk that's, years away. The forecast for a big global supply surplus that's expected in 2026.
Okay, this is where we need to slow down a bit. Because the market reaction, it shows this incredible, maybe even alarming efficiency.
I agree. You're talking about billions of dollars instantly valuing the possibility of peace and a 2026 surplus over the very real active friction that we see every single day.
It just shows the dominance of these forward-looking trading systems.
Algorithmic, absolutely.
I follow the logic, but let me just pause on that. Doesn't that suggest a huge disconnect? If the market is so worried about a surplus in 2026 that it's ignoring supply instability right now, how should you, the listener, process that? Is the current friction just less important?
That's the key question. It means we have to separate short-term price volatility from the mid-term structural risk. The pricing mechanism is telling us that the underlying financial conditions, specifically future inflation and interest rate forecasts, they're now being dictated by the long-term supply outlook.
So this rapid shift in oil prices, it directly impacts global inflation expectations.
Right, which in turn influences everything from real interest rates to household spending power. The consequence is midterm, even if the trigger itself was incredibly fast.
That makes the shift from commodities to central banks a really logical next step. If global resource flows are starting to stabilize, let's look at capital flows. And right now, nowhere are those shifting more dramatically and with such a strong real-life impact than in Tokyo.
Exactly. Let's shift our focus to Japan. The Bank of Japan is finally moving toward monetary normalization. The core issue, the background, is them trying to assess if the recent bursts of wage growth and inflation are sustainable enough to finally exit decades of ultra-low rates.
Okay, so walk us through what happened yesterday.
Market expectation just solidified. The consensus now is that the Bank of Japan is very likely to raise its policy rate to 0.75%.
And just for context, that is a level the Japanese economy hasn't seen in 30 years. I mean, it's a profound symbolic moment and a structural one.
It is. This is a critical moment we call a recombination point. What's so fascinating here is that you have three factors: interest rate differentials with other countries, the yen exchange rate, and domestic inflation. They're all moving at the same time.
Simultaneously.
Yes. Normally, these things move sequentially, one after another, but here they're recombining, and that's creating these really unpredictable pressures.
This sounds very engineered, very deliberate, but what's the potential snag? Does this BOJ move risk some kind of unintended consequence? Like, what if it accelerates capital flight because those rates are still too low compared to the US or Europe?
It absolutely does. That's the risk. The rate hike is designed to tame inflation, which, sounds good on paper.
Of course.
But because that rate differential remains huge, there's a very real risk that capital just keeps chasing higher yields elsewhere, and that would lead to a renewed weakening of the yen.
And that's the primary friction point for you, the listener, and for Japanese households.
Exactly. A weaker yen, despite a rate hike, would instantly increase the cost of imports. It would significantly intensify that cost of living pressure on ordinary households.
So the BOJ's move isn't just some abstract central bank policy. It's all about the implementation layer of making sure that sustainable domestic wage growth is actually meaningful when you set it against the backdrop of imported costs. That link brings us perfectly to our third structural deep dive, fundamental infrastructure. Let's switch gears completely now and look at a really significant city-driven shift in how AI infrastructure investment is being decided. This is particularly visible in Europe.
The background here is, well, it's obvious, but it's vital. Global AI demand requires absolutely massive data centers, DCs. The issue isn't the capital. The issue is power.
And in places like Europe, national grid regulations and resource constraints, they heavily influence exactly where that huge global investment can actually land.
Right.
So what actually happened to illustrate this constraint?
Yesterday, we saw the announcement of a very substantial €1 billion hyperscale DC project advancing in Amsterdam. Crucially, though, the plan is only moving forward because it includes guaranteed tenants and the dedicated construction of a private substation.
A private substation.
Yes, effectively securing 78 megawatts of guaranteed power just for itself.
You know, that specific detail, the 78 megaBU private substation, that feels like the entire story.
It is. Securing the physical capacity to power these massive facilities at the city level, has now become the main entry ticket for global AI and cloud investment. It's no longer about attractive tax breaks or land costs.
It's about the city's ability to guarantee the electrons.
Can you guarantee the electrons? That's the question.
I think this defines a midterm structural movement that will determine global competitiveness. We're seeing investment decisions made today, like this project, which won't even be completed until 2028 or later, that are entirely determined by local power availability.
That's right.
The city's power grid capacity is literally defining the geography of global AI. It shows the ultimate victory of the implementation layer over high-level economic policy.
Precisely. If a city can't guarantee the plumbing, that multi-billion-dollar investment just goes somewhere else.
Okay, that covers our 3 deep dives into major structural movements. Now let's quickly map some of the minor signals across the global membrane. You know, the smaller, localized events that reveal these big underlying issues in logistics and implementation. This is our mini light section.
We've got 5 key points of friction here. Let's start with supply chain friction. This involves Venezuelan crude.
Okay, what happened?
The enforcement of sanctions against Venezuelan crude is becoming intensely physical. It's maritime. We're seeing vessel seizures and direct physical disruption on the water.
And what's the ripple effect we should track from that?
Well, this isn't abstract sanctions anymore. It's physical reality. You have a convergence of physical threats, complex insurance policies, specifically these war clauses triggered by seizures and payment terms. All of this is amplifying supply chain friction across the board.
Which then forces buyers like China to demand larger price discounts.
And that quietly, slowly alters the geopolitical premium in the broader oil market all over again.
Okay, next up, energy route rewiring. This one is centered on Central Asia's crucial export nodes.
So what happened here was a temporary disruption, maybe damage to the CPC pipeline. This is a vital Central Asia Black Sea transport node. It handles about 1% of world supply.
How does that change the calculation for you, for the listener?
The instability of this key transport node is now pushing shippers toward alternative, often riskier routes. And the constant threat of maritime friction in the Black Sea is permanently increasing the long-term importance of internal Eurasian pipelines.
The ones running toward China.
Specifically, yes. It means a temporary pipeline disruption is quietly rewriting the continent's long-term energy geography.
Let's swing back to that AI infrastructure theme we discussed, but let's look at a friction point in the U.S. Local resistance to data centers.
The trigger here. In Chandler, Arizona, the city council flat out rejected a proposed AI data center project.
And that demonstrates the power of the local veto.
Exactly. DC location decisions are no longer just being approved based on tax revenue and jobs. Cities are exercising a kind of defensive reaction, and it's rooted in implementation issues. They're citing concerns over water usage, noise pollution, and resident benefit.
So municipal veto power is accelerating the decentralization of these DC sites away from the major hubs.
It has to.
And on the flip side of that, we have an important data point from Malaysia, which confirms this long-term power commitment model.
Right. What happened was a major long-term, and we're talking 21 years, renewable energy supply agreement was signed for a Google data center. It's going to use large-scale solar power.
What does that imply about the future of investment?
This basically confirms the new rule. Data center demand is so intense that these companies are preemptively locking up long-term dedicated power sources. The speed of investment in any region is now explicitly limited by the state or city's ability to guarantee land, water, and system capacity for decades, not just for years.
Okay, our final light signal. This one relates to the logistics layer we talked about earlier. Internal regulatory friction.
What happened here is that several major logistics firms reported significant delays in moving crucial components across Central and Eastern European borders
And why?
because of newly implemented localized customs inspection rules regarding non-EU goods.
So what does this tell us?
It tells us that these minor regulatory changes at specific land borders are causing disproportionately large delays. They're increasing dwell time and transport costs for specialized industrial components. It shows that even small changes in local administrative rules, that implementation layer, can create a massive choke point in these pan-continental supply chains.
That mapping really shows us just how layered and fragile global friction is becoming. I mean, from insurance policy war clauses all the way down to a city council's decision on water usage.
So what's the overall picture that emerges? If we connect the oil market moves, the Japan rate hike, the hyper-focus on power infrastructure, and all those tiny logistical frictions we just mapped, yesterday showed us a fundamental truth.
Which is?
The flows of capital and resources are no longer primarily dictated by loud, abstract issues like sanctions or major wars.
Instead, the world's momentum is increasingly being set by the micro details of that implementation layer. Dedicated private power grids, the nuances of insurance costs, city-level regulations.
And complex payment system that can actually seize vessels at sea. The structures are shifting from the top down to the bottom up.
Precisely. The question is no longer if you have the money to invest.
It's if you have the guaranteed power and the local permits to spend it.
So, given this major structural shift, what should listeners be paying attention to next? Where is the tension building that we need to watch over the next year or two?
The tension is highly concentrated at the intersection of two critical areas. First, it's power and DC infrastructure. You need to watch the grid connection queues, the struggle for global companies to secure long-term dedicated fuel or renewable sources, and the actual speed of regional grid upgrades.
And the second area?
Second is urban governance, the response of what we call the City OS. Look for how cities react regarding resident benefit, the critical issue of water scarcity, and of course, the efficiency of their permitting processes.
So that convergence of power constraints and municipal veto power.
That is exactly where the next major bottlenecks will occur, and it's going to determine the geography of global investment for the rest of this decade.